Good morning, everybody, and happy Thursday. Today's October 26, 2023. U.S. GDP growth of 4.9%. Our economy is booming. President cognitive decline. Your economic plan is working. Everything is great. We're all going to be rich, right? Well, not so much. U.S. GDP growth came in at 4.9% year over year. That is a shocking number, to say the least. It came in much higher than expected. The average survey of economists was expecting something like 4.3% year over year growth, and that's up from just 2.1% in the prior quarter. So what happened? Did the economy suddenly start thriving? Is AI causing all this increases in productivity and production, and we're all booming, and there's, well, just prosperity everywhere, right? Walk up and down the street in every major U.S. city. You can practically smell the prosperity, right? You might think that's human excrement and urine that you're smelling, but no, it's prosperity. The economy's just doing great. The smell is in the air, right? Well, all it took was, $600 billion of U.S. government deficit spending during the same quarter, along with, well, what do we have now? $1.019 trillion worth of credit card debt in the United States. So it's not real economic growth. This is just a nation of governments, companies, and individuals spending money that they don't have. Trillions of dollars that we don't have. And sure, that looks like economic growth for a little while. But of course, once that sugar high wears off, you're left with the pile of debt and this unproductive economy and no way to pay it off. Other data we got out this morning, we got PCE, or personal consumption expenditures. That's the Fed's preferred measure of inflation. The headline PCE number, that came in a little bit higher than expected at 2.9%. That's up from 2.5 in the prior quarter. But core PCE actually came in down. It was 2.4%. That's where you strip out food and energy because, people don't need food and energy. That's down from 3.7 in the prior quarter. The market was expecting about 2.5. Now, the market is rallying on this news. I'll be honest with you. I was sitting there talking to my moderator, Mish. This data all came out just about 30 minutes ago, and I'm scratching my head at this news, and I'm watching stocks rallying. They were down big this morning because Meta's earnings disappointed yesterday. Everybody was saying, oh, what a beat, what a beat. We'll talk a little bit about Meta's earnings and why I don't think they were actually very good. But the market is rallying on this. Bond yields are dropping on this. I'm sitting here scratching my head, guys, because I'll be honest with you, I don't understand the market's reaction to this data. I think the market is getting it wrong. Jerome Powell has said he needs to see a slowdown in economic growth. I mean, his words, he said it over and over and over again. A sustained period of below trend growth is going to be required in order to defeat inflation. Well, 4.9% is not below trend growth. So if you're looking at this data and you're saying, oh, great, I guess inflation has been beaten and the Fed is going to start lowering any day now, that's not what Jerome Powell said. That's not the criteria that Jerome Powell laid out for why he would be done hiking. And the market is just convinced that the Fed is done hiking. Oh, and by the way, it is irrelevant if the Fed is done hiking or not, because the Fed has already hiked too much and they have already killed the economy. We just don't know it yet. Other stories going on this morning. The UAW has reached a tentative deal with Ford. Could be a sign that the end of the auto worker strike is upon us or is approaching quickly. UAW and Ford reached a deal for a 25% raise over 4.5 years, along with increased cost of living adjustments. It boils out to about a 33% increase in wages over 4.5 years. Not the 40% that the UAW was asking for, but a nice raise, certainly more than most people got this year. But even when you think about that, guys, a 25% raise over 4.5 years, that really just wipes out the inflation of the last year. I mean, we know what CPI was reported as in 2022, but let's be honest with you, life got about 20% more expensive last year, didn't it? So all they're doing is playing catch up to one prior year's worth of inflation. They're only getting it spread out over 4.5 years. And, inflation might continue for a few more years after that, or prices may go up anyway. So the market's a little messy this morning. just suffice it to say, let's shrink my big melon of a head and see what's going on in markets this morning, shall we? And while we're shrinking my big melon of a head, won't you please hit that like button, subscribe to this channel? It really helps me out and also helps get this message out. And if you're new here, subscribe. We do this every morning. The CNN Fear Greed Index is currently at 29, where it has been residing for the last couple of weeks. That is an up-to-date number, last updated this morning. The S&P 500, there you go. Look at that big green candle right there. That was the release of those GDP and PCE numbers, along with the initial and continuing jobless claims. The market is just loving this news. Again, I don't get it. I really don't get it, but the S&P 500 currently down only 8 points or 0.2%. It was down significantly ahead of the opening bell before that data came out. Just want to take a look at the long-term trend of the S&P 500, guys. We lost that 200-day moving average yesterday in a big way. Bad technical indicator right there. Let me just show you guys what we got here. Well, you can see it there on the screen. We don't need to go through that again. But that is a technical breakdown. Now, the market is right now rallying off of this GDP news. I don't know if that's going to be enough to recapture that 200 line. My gut tells me it's not. But I'll be honest with you, my gut right now doesn't really agree with what the market is doing. So maybe we don't go with Jack's gut this morning. Looking over at the Dow in positive territory, look at that big green shoot up as soon as that data came out, up 10 points now ahead of the opening bell after being down a few hundred earlier. And even the NASDAQ is getting in on the action. The NASDAQ was down another 150 points this morning at one point. That's after losing over 300 points yesterday. But on this GDP news, the NASDAQ is rallying. Why? Because people bought tickets to see the Barbie movie. I guess that means AI mania is real and NVIDIA earnings are organic, and forget the whole CoreWeave and, channel stuffing thing. No, it's all authentic organic growth, right? Because Barbie movie, because Taylor Swift tickets, tech stocks are rallying. Okay. All right, sure. NASDAQ down 64 points ahead of the opening bell. Again, that's way up from where it was just a few moments ago. And guys, the NASDAQ, if you look right here, we are sitting right about that 200-day moving average. So we had that technical breakdown in the S&P a couple of days ago. It looks like the NASDAQ is set to follow suit unless the market's just going to rally all day off of this news. Looking over at the commodities board today, we got December gold futures are down $7.70, trading at $1,987. That's down about 0.4% this morning. December silver futures are also down about 0.5% or 13 cents, trading at $22.88. We have got platinum is up about 0.7%. January platinum futures $918. December palladium futures at $11.30. That's down about 0.33%. Crude oil getting crushed this morning, down another 2%. $83.66 for West Texas Intermediate December futures. But wait, all the economic growth. Why is oil falling? We've got all this economic growth and prosperity. Why would the price of oil be going down? Again, the market's reaction today just doesn't really pass the sniff test with me. The DXY right now is up about 12 basis points or 0.1% higher, trading at 106.63 on the Dixie as the dollar continues to strengthen. And bond yields, interestingly enough, we're seeing the yield curve is reacting, at least on the long end, is heading lower this morning. We got the 30-year is down almost 5 basis points at 5.04. The 10-year at 4.928. Now, that's down about 3 basis points. Now, guys, I would just add that the 10-year this morning at one point was trading as high as 4.993. Look, that whole Bill Ackman thing when he announced on Monday that he had covered his short and bonds rallied. Look, if you haven't gotten the memo by now, let me give it to you again. Never, ever, ever move money based on something Bill Ackman says. Bill Ackman is a low-life line POS who uses his microphone and his platform to move markets in favorable directions for him personally and his fund. Do not ever move your own money based on something you see from Bill Ackman. All right. I can't tell you enough. The guy just absolutely gives me the creeps. Why anybody listens to him or hands him a microphone after what he pulled in 2020 just amazes me. On Monday, an Ackman announced he had covered his bond shorts and bonds started rallying, and then they gave up all of those gains in the day or two afterward. Don't ever trade based on what you hear from Bill Ackman or me, from that matter. Don't ever trade based on what you hear from me. Look at the data, come up with your own conclusions, and trade based on your own unique situation. The 2-year Treasury is yielding at 5.087. That's down 3 basis points this morning. And the 1-month, 5.401, basically flat on the day. And here we go, looking at the 10-year Treasury, guys. Oh, look, here is that big rally in bonds. Yields going lower. Remember, that's bonds prices moving higher. There's that big Bill Ackman rally. And, oh, yeah, we just came right back up. Again, never, ever, ever trade based on what you hear from Bill Ackman. Another interesting thing to keep an eye on, guys, the Bank of Japan expects something from the BOJ. We've been talking about this for a while. The Japanese yen broke that all-important 150 level yesterday. It now takes 150.2 Japanese yen to make $1 US. And the last time we were at this level was back here in October when the Bank of Japan intervened. They sold dollars, they sold US treasuries to buy their own yen to try to support their own, to support their own currency. Now, this is important, guys, because interest rates on Japanese government bonds, the 10-year JGB, are still rising. The Bank of Japan announced a few days ago an unscheduled bond buying operation, which means they were printing yen to buy bonds to try to push the interest rates lower. That unscheduled bond buying operation was largely ineffective, which means Japan either needs to put more firepower into that. They need to print more yen to buy even more to push them lower, or they need to let those yields rise higher. Either way, that's going to cause problems for the U.S. bond market, because where does Japan get dollars? They get dollars from either swap lines with the Fed or selling U.S. treasuries. If they sell U.S. treasuries, they're going to drive those prices lower and those interest rates higher. Bad for U.S. stocks, bad for the U.S. economy. Conversely, if those interest rates keep rising, if the Japanese let those interest rates rise, that's going to cause an unwinding of the yen carry trade, something I talked about with Michael Gayette a couple of months ago on this channel. You can check out that interview if you want from a few weeks ago. If interest rates in Japan rise, right now people borrow money where it's cheap in Japan and they come over to the States and they buy assets with it. If those interest rates in Japan start going up, that trade goes away, and that is largely responsible for supporting this U.S. asset bubble. Either way, what's happening in Japan right now is not good for the U.S. economy. Now, we've got the yen is falling as this chart moves higher. Remember, this is the yen's value falling against the dollar. So we've got the yen falling at the same time the 10-year Japanese government bond yield, that's this one right here, that is also rising, currently at 0.88%. Now, that's, again, not good. The Japanese are either going to suppress yields by dumping dollars, or either suppress yields by printing yen, which will devalue it. What the Bank of Japan is doing, sooner or later, they're going to intervene here, and it's going to cause a real mess in the U.S. market. Keep an eye for news from the Bank of Japan. But the real story this morning, guys, the real story is U.S. GDP growth rate. Just shocking. The U.S. economy expanded annualized at 4.9% in the third quarter of 2023, the strongest GDP growth since the last quarter of 2021. And the last quarter of 2021, you might recall, that was the last time we printed any money and injected it into the economy. Now, we're not doing that right now. We're borrowing money and injecting it into the economy, and we're running out of time. We can only do that for so much longer. By my accounts, by February, we won't be able to do that anymore. That's above market forecast of just 4.3%, and it follows after a 2.1% rise in the previous 3 months. The advanced estimate showed the increase in real GDP reflected increases in consumer spending, private inventory investment, exports, state and local government spending, federal government spending, and residential fixed investment. That was partially offset by a decrease in non-residential fixed investment. Guys, we're spending money we don't have in every corner, every facet of the economy. All right. Hundreds of billions of dollars in government spending. Consumers are spending money that they don't have, putting it on the credit card. People are, look at this, residential fixed investment. People are still borrowing money and putting it into their houses? Really? Well, okay. Good luck with that. Looking ahead to the last quarter of the year, a slowdown in GDP growth is anticipated. We'll talk about that in a second. That's due to a resumption of student loan repayments in October and the UAW strikes. That's going to take a bite out of GDP. The Fed expects the U.S. economy to grow 2.1% this year. Now let's look at, here's largely what was responsible besides government spending, obviously, but consumer spending surged again in this quarter. 4% growth in consumer spending in the U.S. There it is right there. That's up from just 0.8 in the second quarter. There's your Barbenheimer. There's your Taylor Swift and your Beyonce tours. I don't really buy that narrative, guys. I really don't. But there it is in the number. People spending more money, and everybody swears it's because of Taylor Swift and Barbie. Maybe I just want to have more faith in humanity than that. But okay, that's why people are spending so much money. PCE prices quarter over quarter. This is personal consumption expenditures. This is the Fed's preferred gauge of inflation. The price index for personal consumption expenditures in the U.S. rose by an annualized 2.9% in the third quarter, according to preliminary estimates. That's following an increase of 2.5% in the previous 3 months. So we got a slightly higher inflation read here. Now, PCE almost always comes in below CPI. The math is different. So don't worry so much about the nominal number here. Pay attention to the direction of the movement. And we actually saw an increase in inflation this quarter. Again, I don't really get why the market is looking at this as good news, seeing above trend GDP growth, seeing higher inflation numbers when Powell told us he wants to see below trend GDP growth and lower inflation numbers. There's that optimism. Now, there is something to be a little optimistic about. Check this one out. Ford and UAW reach a tentative deal to end the strike, including a record pay raise. Now, again, Jerome Powell has said he doesn't want to see wages rising so fast. He wants to see reduced tightness in the labor market. Jerome Powell wants to see wages dropping in the U.S. He won't ever say that because it doesn't trend well in focus groups, but that's essentially what he's saying. Well, he's not getting that today either because Ford just cut a deal for a big raise. The United Auto Workers Union reached a tentative labor deal on Wednesday with Ford Motor, the first of Detroit's big three car manufacturers, to negotiate a settlement to strikes joined by 45,000 workers since mid-September. The proposed accord, which UAW's leadership must still approve, provides a 25% wage hike over 4.5-year contract, starting with an initial increase of 11%. The Ford deal, which could help create a template for settlements of parallel UAW strikes at General Motors and Chrysler parent Stellantis, would amount to total pay hikes of more than 33% when compounding and cost of living mechanisms are factored in, the UAW said. So Ford is getting a big raise. Ford workers are getting a 33% by the time you compound it and add cost of living adjustments, a 33% increase in their wages over 4.5 years. Congratulations to you Ford employees. Although again, guys, after the last couple of years of inflation, these guys, they're just about breaking even on this deal. Now, I want to talk about another story because it kind of shows you where this might be heading. We just got this from Southwest Airlines today. Now, keep in mind, the airline unions just got big pay raises a couple of months ago. And also keep in mind all the summer travel. Remember Taylor Swift, remember Beyonce tickets, right? Well, look what's going on at Southwest. And this is why I don't think the market is getting the right message today, because what's happening in Southwest right now is kind of a microcosm of what's going to happen to the entire freaking economy in the next quarter. Southwest Airlines quarterly profit slides 30% and says growth will slow next year. Southwest Airlines third quarter profit fell 30% to $193 million despite record revenue as leisure travel boomed over the summer. So, all right, there's your Taylor Swift tickets, right? Leisure travel boomed over the summer, record revenue, but profit fell 30%. That means inflation is destroying the business model at Southwest Airlines. The airline's labor costs rose sharply. Pay attention, Ford shareholders. The labor costs rose sharply, however, more than offsetting the increase in revenue. There's inflation killing businesses making a mess. Southwest predicted Thursday that a key measure of pricing power will fall sharply in the fourth quarter, and it will scale back its aggressive growth plans early next year. So they're bringing in record amounts of money, but their profits are down sharply because they've had to pay so much more to their employees. And because of that, they're going to scale back investments in their business, which means future quarters are going to suffer. CapEx is going to be reduced. This is economic growth being forecast right here, or reductions in economic growth being forecast by Southwest here. And this is one of the companies that was the primary beneficiary of everything that happened over the summer, right? The airlines were some of the were some of the best performing companies because everybody was following Taylor Swift around the country and following Beyonce around the country. And now here we are just a few weeks later, the airlines are getting crushed. The results, and particularly Southwest plans to throttle back on growth, are likely to add to concerns that demand for domestic travel, the heart of Southwest business, could weaken. And once again, guys, you almost always get a great nugget of information in the last paragraph of an article on Bloomberg. And today it did not disappoint. All of the airlines face higher labor costs, but unlike its three closest rivals, Southwest has not reached an agreement with its pilots on a new labor contract. So even though Southwest has already seen this big surge in their labor costs and their profits are down 30% despite record revenues, and they're already scaling back plans for growth, they still haven't settled up with their pilots. So things are going to get worse for Southwest, not better. So again, when you hear everything in this Southwest article, yeah, booming summer travel, but we're losing pricing power. We're cutting back on our investment growth. Our profits are falling. This is everything wrong with the economy wrapped up tidy and neat in one little story. Shout out to my moderator, Mish, who caught this one this morning. Now let's talk about another one going on in the economy, Meta earnings. All right. And forget this word strong here because I don't think these earnings were very strong, but Meta reports strong Q3 earnings beat. Mark Zuckerberg talks AI, threads, and hiring faster next year. Let's forget threads. It's a joke. It was nothing more than a Twitter clone that the liberals were celebrating because, oh, yay, we're bringing back censorship. And nobody went there. Threads, they were like, oh my God, the growth in threads was so amazing. Has anybody been on threads lately? Have you threaded? What do they call a tweet in threads? Whatever. Threads is a failed experiment, much like the metaverse. But Meta Platforms reported third quarter earnings after the closing bell Wednesday that beat analyst revenue and profit estimates. And you can forget analyst revenue and profit estimates because they're always artificially low. That way, everybody reports a beat. It's basically everyone gets a trophy, but with stocks. The beat was driven by continued rebound in Meta's advertising business following a sharp slowdown through 2022. Now, that is accurate. There was a rebound in the ad spend. We also saw that a little bit with Snapchat and a little bit with Google, also slight rebounds in advertising spending. That's a good sign. Meta's guidance on its 23 and 24 expenses also hit the sweet spot for investors as it signaled that it can balance its year of efficiency cost-cutting efforts while it continues to invest in metaverse and artificial intelligence. Now, there's so much wrong with that sentence, I don't even know where to begin. First of all, the sweet spot and the year of efficiency cost-cutting, remember, that is tens of thousands of people getting laid off. Meta has been absolutely slashing its headcount. That's not a good sign for the economy. All right, the advertising spend is nice to see that going up. That's a good sign for the economy. But the year of efficiency and the cost-cutting efforts, that's people losing their jobs. And if people are losing their jobs and they're not working, then advertisers won't have anybody to advertise to because nobody will have any money to spend and buy anything. And the other thing, as far as continuing to invest in metaverse and artificial intelligence, they took a $3.7 billion hit from this investment in the metaverse. I mean, they changed the name of the company to Meta. They coined the term metaverse. It was supposed to be this next big thing. It is a total flop, and the company is still pouring cash into the metaverse. Why? Because Mark Zuckerberg is an egomaniac who can't admit that his idea is stupid and people don't want it. There, I said it. Oh, and speaking of artificial intelligence, Meta, Facebook, AKA, right? They're up like something like 200% year to date, all on this AI boom. Well, you don't get to artificial intelligence once again until the last paragraph of the article. Now, here is the big delivery on all the promise of artificial intelligence, right? After everything we've heard about AI over the last year, it's been almost a year since ChatGPT was announced, about 11 months. And Facebook was one of the biggest beneficiaries of the AI mania. Here's the big soundbite we get about artificial intelligence. The executive says that over time, Meta will be able to use AI to create content for people on its family of apps based on their interests. That's it. Oh, over time, AI will give us content. So great, you're going to have a chat bot creating what? Fake pictures, fake video, fake stories for people to mindlessly consume on your addictive platforms that harm little girls, and you're being sued by every attorney general in the freaking universe because of it. And that's your big AI mania delivery, is over time we'll use AI to create fake content. All right. Well, that's going to work out just about as well as the metaverse did for you. Good luck with that one, Zuck. Meta stock, let's see what they're doing right now. They were initially popped about 6% yesterday after hours, currently down about 1% ahead of the opening bell. So again, this big beat, I don't really see it. I don't consider that a big beat. Last but not least, guys, something nobody's talking about. There's a few people in FinTwit talking about it. This happened yesterday, and this story stinks. Trading in some stock options halted for second time in a week as exchanges are hit by an outage. Trading in some U.S. equity options was briefly halted on Wednesday as a critical piece of options market plumbing suffered its second outage in a week. A processing issue at the Options Price Reporting Authority, or OPRA, an entity that collects and aggregates data on options trades from the 16 U.S. options exchanges, forced CBOE Global Markets, which operates 4 of those exchanges, including the largest by volume, CBOE Options Exchange, to temporarily suspend trading in so-called multi-listed options, which trade on multiple exchanges, according to a statement on the exchange operator's website. So the options market went down yesterday for about an hour. It's the second time in a week that has happened. And I just mentioned it happened on a day with a pretty wicked sell-off, 320 points down in the NASDAQ yesterday. So this is something to keep an eye on. This has happened twice in the last couple of weeks. No details on what took it down. Was this just another glitch? Was this another totally not a hack? Or are we just operating the options exchanges like we operate shitcoin exchanges now, where every time market conditions are unfavorable to market makers, we just have a very well-timed maintenance outage, or we go down for scheduled maintenance, or we have technical issues every time the trade doesn't go our way? I don't know what this was. Second time in a week this happened, but pay attention to what's going on at the CBOE. Something here stinks. And it's getting very, very little coverage. No mention of it in the mainstream press. So keep an eye on that one. And I got a couple of thank yous I got to send this morning to Mr. Mike Kathman. Thank you, Mike. He says 33 trillion. Can we just smack some sense into them? No, we cannot smack some sense into them. I wish we could. But unfortunately, guys, the Uniparty is still an exchange, is still in charge over in Congress. I mean, we got this new Speaker Johnson, who nobody has ever heard of. I don't know who this guy is that they just put in charge. He's now third in line of presidential succession. This random guy from Louisiana that nobody's ever heard of. Okay, I wish him luck. I'm not terribly optimistic, to be honest with you. Ultimately, what do I think he's going to do? He's going to take his new gavel, he's going to smack it, and he's going to spend another $1 trillion like every single one that came before him has done. I just don't think anybody in D.C., outside of a handful of people who are viewed as radicals, and some even call them domestic terrorists, I think there's only a handful of people who actually care about cutting spending in Washington, and they have very little power. So, we're watching that reverse repo trend go down. We've got about $1 trillion of liquidity to spare in the bond market, and when that is gone, something wicked this way comes, and the people in Washington are not serious about doing anything about that. Conversely, they seem to be doing everything they can to accelerate that. Janet Yellen's going to keep issuing new bonds. They're going to spend a whole bunch more money on wars. I mean, we're already involved in a 2-front war. The Chinese would just love to open a third front. That's going to do wonders for your government spending. I'd love to smack some sense into him, Mike, but I just don't think it's going to happen, brother. Thank you very much for the super chat and the support of the channel. And thank you, Steve Woitas says the more government borrows printed money and spends it, the higher GDP is. GDP equals federal debt. Steve, that works only up to a point. They are borrowing printed money right now because we're seeing that money is coming out of the reverse repo. The reverse repo, that's extra money that they printed in 2020 and 21, right? That's almost gone. When there's no more printed money to borrow, a couple of things could happen, right? Number one, they could fire Jerome Powell, replace him with somebody who spins up the printers again, and they could print more money. That's what they've done every other time this has happened. So maybe they do that again. Well, if that's the case, say hello to double-digit inflation again, and we've enjoyed what that has done for the last few years. That's one possible outcome. Another possible outcome is maybe the 5 wackos in Congress who want to cut spending, maybe another 195 or 220 people you need in Congress to get something done. Maybe another 215 people in Congress suddenly grow a set or a conscience, either one, and decide they're going to try to cut spending. Maybe that actually happens. I doubt it. The third possibility is the government runs out of printed money to borrow, which right now is on pace to happen sometime around February 12th. When that happens, borrowing costs skyrocket. And when borrowing costs skyrocket in a debt-based economy, everything grinds to a halt and breaks. Right now, I think that is the most likely outcome. And we're on pace for that to happen sometime in mid-February. I don't know if it's going to happen or not. Maybe we slow down spending. We're probably going to speed up spending rather than slow it down. But they are about to run out. But right now, you are right. GDP equals federal debt. The government deficit spending in the United States is something around 8% of GDP. If you take that away, you have the worst recession since the Great Depression, just on the act of balancing the federal budget. There is no easy way out of this mess. Thank you, Steve Woitis. Appreciate Super Chat, sir. And thank you, Lisa Wrestler. Lisa says, good morning, Jack. Thank you for all the information you provide. It's very much appreciated. Have a great day. Fresno, California loves you. Hello, Fresno. I love you, Fresno too. Thank you, Lisa. I appreciate that very much, the kind words. And thank you for spending your morning with us here on the Morning Update Live. And thank you, everybody else, for your time and for supporting the channel. And thank you also to my Patreon supporters for everything you guys do for the channel. We got a link down below should you feel so inclined. It's going to be a weird one today, guys. Fake economic growth. The market is celebrating it. We'll see if that one lasts. All right, everybody. I just want to say hi, Mom. Hi, Dad. I love you guys. Until next time, live small and dream big.